All right, we are live. Hey there, welcome. Thank you so much for joining me. I think we have a couple of things that are really important that we need to get past. We need to get past a few things. And I think those things are that inflation is here longer than you want to think. And there are reasons for it, very good reasons for it. And I think we all need to consider that the economy is stronger than anyone predicted. And I don't really see much of a reason why it's not going to continue to be this strong. We could be set up for, dare I say, a 1990s style move up with starting higher inflation and moderating over years while inflation comes down, while the labor market remains strong, and corporate growth rebounds not so much that it gets things out of whack. And this could go on for a long time. So we're going to roll the intro. These are really like big, broad based, let's say, what do you call that? Broad based brush things to consider. Here's the intro. Stick around. We're going to clear up a couple of things. Here we go. All right, thank you for joining me. I'm Mitch Goldberg. You're watching Be the Boss of Your Money. It's a show about, I should say it's an entertainment show, right? Now it's about personal finance, investing, and talking about things endlessly that could possibly make you better with your money, better decisions, better investing, better decisions in terms of tax implications. We don't give tax advice here, and I'm not your tax advisor, but we want to make decisions that could impact you in a positive way many years down the road. You know, I like to say, I don't have a crystal ball. No shit, right? I mean, people in my business like others to think that they know something, that they have a crystal ball, that they have an idea, that they know if the market bottomed out or not, that they know if we're going back up. And of course, they change their mind like everybody else. It's so much of a burden to carry that around to try to portray some kind of image that they think that financial advisors think could make them look smarter or more able than they are in that area. And I say, what a bunch of bullcrap. We don't need that. What we need to do is let all that go. That doesn't help you. Doesn't help me. And I don't have a crystal ball. And hopefully that resonates with some of you that says, I want to use someone like that who openly admits he doesn't have a crystal ball. Right? I mean, people want you to think they know something. I have something better than a mythical crystal ball. I have patience. Patience is really what works. Patience is why Warren Buffett has demonstrated market beating returns through thick and thin over time because he can wait, because he buys good companies. He knows what he buys. He buys a lot of companies and he waits. He waits for things to work out. He waits for things to materialize. He doesn't just say like buy good companies because there are a lot of ways you could define a good company. Well, what's a good company? GE was a good company. IBM was a good company. When I got into the industry, when I was knee high to a grasshopper in 1990, I graduated college in 89. And, the two stocks that you would buy for yourself and for any client, like the first two stocks that go in a portfolio were IBM and GE. They were the you can't go wrong stocks. Later on, it became Intel and Cisco and Microsoft, which Intel and Cisco never really did anything. Microsoft certainly worked that well. That's if you bought it and held it Microsoft, if you held it through the 2000 tech wreck and held on to it for about 15 years just to get back to even, and then after that, the stock really took off. Same with Apple. Okay, so it's patience and a good company with a good business plan that says what they want to focus on, what they want to deliver to shareholders, what they're researching, and then forget about the price of the stock. Are they following a process? Are they following the plan? That's all you want to know. And the stock will take care of itself. At least that's what long-term investors do. And we talk about, a lot of people talk about, you can't beat the market. You can't time the market. And by and large, I agree with that wholeheartedly. And I talk about that all the time. Time in the market is way better than timing the market. But I also can tell you, I have many clients who have beat the market because they've just simply held on to their stocks and their really good funds for so long that they beat the market. They did better. They did better than the market. They did what everyone said they can't do. Not because they were more sophisticated, not because they're more experienced, but because of a personality trait of being patient. It's the hardest thing to come by, patience. Because when you put on CNBC or you open up the Wall Street Journal and so many other media outlets, you never see the word patience. You see the word trade, buy ahead of earnings. We're not out of the woods yet, which is a common refrain on Wall Street. So when an analyst or somebody gives you their point of view, we think this is going to happen. We're past the bottom of the market, but we're not out of the woods yet. It's like everything you say, but we're not out of the woods yet. If that's like your final statement for everything you say, you're always hedging. And then that's why people keep watching because, you as a financial participant, an investor, a saver, someone who's getting ready for retirement or in retirement and you want to stay there in a financially healthy way, you're not looking for, but you're not looking for, but we're not out of the woods yet. You're not looking for this should happen. We expect this, but let me give you all the other things. Just come out and say, I'm going to be, open and honest with you and say, I don't know. The risks to the downside and the reasons for the upside are basically, in my opinion, equal. And we could go either way. Now I will tell you this, Mitch here, we have been stuck in a trading range of the market for a while now. I have my own opinions. And I've said this to many of a client, and I've said this on the show. I have my opinions of where the market's going. I have my opinions of which stocks and exchange traded funds that I want my clients in. But I by no means want your financial future to depend on my opinion of the moment. It wouldn't be right. It wouldn't be fair. Who says my opinion is so good? I'm like any other guy. I think highly of my opinion, but I leave it, I leave it in front of it doesn't get past the front of my face. I want you relying on investing long term. And as your needs get closer, as your financial obligations for your investment money gets closer, we start moving that money into cash well in advance so that you're not forced to sell into a down market, so that you're not forced to liquidate positions at the worst possible time and not have time to gain them back, to make the money back. We want to make sure that you are not, I want to make sure, my team here, we want to make sure that you're not experiencing so much downside in your portfolio that you could never recover. How many of you have bought stocks or bought investments? Your account went down so much, you don't even know what to do anymore. It's like you'll never make that money back. We want to avoid that. We also want to avoid the threshold of pain. That is when your portfolio, your account drops so much that you decide, I have to sell. I just have to get out. The pain is too much. I don't want to lose all my money. And I'll get back in at a better time. Of course, we all know getting back in at a better time never works. Does it? Does it ever work for you? So, staying in the proper portfolio for you, withdrawing funds, distributing funds out of the stock market well in advance of your financial obligation, that's the way to invest. The rest of it is yada, 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 blah, 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 gibberish, gibberish, gibberish. It's patience. And you don't hear analysts talking about that. It's almost like a secret. Like, we don't want you to just be patient. We want you to rely on us so that we could guide you through the market. I'm not insecure that, like, if I say just be patient, that you're going to take your business elsewhere. I actually think you're going to want to do business with someone like me who preaches patience, because that's what you need when your stuff hits your effing fan. That's when someone like me does my job. That's when I go to work. That's when I earn my keep. That's when I earn my fees, by keeping you invested in a portfolio that you could live with and keep you from making those horrible decisions of bailing out at the worst time, so that you can continue to grow your portfolio over the long term, over time. Patience. It's what makes me a professional. Let's give credit to the economy. The economy is doing, I think, well, it's clear the economy is doing better than it's getting credit for. And what do I mean by that? Well, let me tell you what I mean by that. All right. 2 Fridays ago, we saw the unemployment figures come out, the January unemployment figures, and they were like way, way stronger than anybody expected. 517,000 new jobs, and job increases were revised higher for the prior 2 years, 2021 and 2022. But there are other things going on in the economy. It's not just a short-term blip in employment. Now, listen, if the unemployment rate starts to tick up a little bit, well, we're at the lowest unemployment rate since 1969. So it wouldn't be a shock to see the labor market moderate a little bit. That wouldn't be a shock. It doesn't mean we're going down the toilet. Oh, we only created 200,000 jobs this month. That's it. It's over. Let's dispense with the hyperbole, okay? Between the Inflation Reduction Act and the infrastructure spending, the infrastructure law, whatever you want to call it, the infrastructure spending law, I don't think it's factored in yet into how big these programs are, that they're going to create so many jobs for a long time. It's really remarkable, the strength of the economy. But we have to accept the flip side is that inflation will be with us longer. Now, could we live with the inflation, I guess, is the real question. Because if you can't live with the inflation, you might as well just take your ball and go home now, sell everything and get out. Do we get past the inflation? Well, let's take a look at why I think the inflation we're having is persistent. 3 sectors of the economy have changed the way they do business: the energy sector, the automobile manufacturing sector, which basically is GM, Chrysler, and Ford. Okay. And the energy sector have all changed. All three of those sectors were about volume, selling more stuff, making more stuff, mining more stuff, and selling more. More. Unit sales, barrels, quantity. It wasn't about quality. It wasn't about profitability. Airlines just wanted to fly more people, get more tushes in more seats, and move more people. That's what they were about. They weren't about taking a route that costs $200. They were about taking a route that costs $200, but flying people for $50 because they had to fill the seat. Now they're about flying you in a route that costs $200 and charging you $500, and you saying, Sure, of course they'll pay. It's about these sectors have reconditioned us to expect that they are here for the profits, not for the volume. Energy companies, energy company executives were paid to produce more, for more production, more volume, more stuff going through pipelines. Airline executives were paid to see how many butts in seats. Car executives, how many cars they could sell. It's all about profit. It's completely changed the ball game. And these are very consumer facing, business facing services and manufacturers and miners. So that is one reason why I don't think inflation really is. That's really one reason why I don't think inflation moderates to the extent that people think it could. The other thing, and this is an even bigger, a bigger factor behind inflation, is the reshoring of capital, of manufacturing capital. The world was made for redundancy. I'm sorry, the world was made for efficiency. We manufacture chips, semiconductor chips, in the most efficient factories, meaning the cheapest factories, the highest quality chips for the lowest possible price. That's where the manufacturing goes, and that's all the manufacturing. That's efficiency. When the Ever Given ship, the giant oil tanker, was stuck in the Suez Canal, that was efficiency. Moving oil from one place to the next, not having backups. The world is made for efficiency. Supply chains have become perfect. Stores go by just-in-time inventory. And when that happens and there's a supply chain disruption, stores don't have any inventory. They run out of goods to sell. Prices go up. Consumers have less choice. Revenues go down with retailers because they finally could sell stuff for a profit, but they can't get enough of it. It's all about the stuff, right? Reshoring our technology prowess, our manufacturing, because we need redundancy, not just efficiency. This is the big, big, big thing that's taking place. We could still manufacture chips in China. We could still make stuff all over the world. But we need to make stuff here too, because we need to make sure our supply chains are safe and secure here. With political strife, I'm talking in Europe, Ukraine, Russia, war, what's going on with China, notwithstanding just the balloons and all that, the satellites, that the low-flying airborne satellites are sitting over the United States. We have now become a country that has to look in and manufacture here. This is really good for jobs. We're no longer, to the extent anyway, offshoring jobs to places where people make, 10 cents an hour. We have to keep it here. It keeps the labor market strong. It keeps the economy strong. And it keeps inflation perpetually higher. Now, the rate of inflation could go from 6 to 5% or 4%. It could go back to 9 or 10%. Well, it could go back to 9%. We didn't hit 10% in this cycle. The point being, inflation is here to stay. Does the economy have enough escape velocity to outrun the gravitational pull of value crushing inflation? We're going to find out. But I think it does. I really do. I think it does. Again, that doesn't mean that if you're fully invested and you have a financial obligation coming up in a year, it doesn't mean that you should stay fully invested. You should still do the prudent thing and take money off the table for your financial obligation in a year. Okay, don't try to maximize every little dollar of gain in your portfolio, because you might wind up maximizing losses at the worst possible time before you need the money, before you need to start liquidating your investment portfolio to replace your income. Okay, that's what this is all about, right? It's about amassing a portfolio of securities and slowly converting that into your income. This is why boomers were desperate for dividend yields the last couple of years, and they're throwing all their money into high priced consumer staple stocks because they're getting dividends. Now the dividends are okay. Stocks have gotten crushed, and now they don't even have the money now because they're locked up in stocks for a 4.9% yield on a 6-month T-bill. But that's what's happening, folks. Reshoring of jobs and those three industries I mentioned, automobile manufacturing, energy, and airlines, operating with a different business model. That's why I think inflation is here to stay. Do we live with it? We'll see. Tomorrow morning, the inflation figures, the CPI is coming out. It's expected to be 6.2% year over year inflation. We will see what it says. If it's much more than that, I would think we're in for a pretty heavy down day. If it comes in lighter, Fed still says they want to keep rates high and higher for longer. The Fed is getting away from that whole concept of saying, oh, we might be able to pivot by the end of this year. No, the Fed actually wants to keep rates up for a while. So I don't think we get a pivot this year. I'm hoping we just get a pause. When the Fed stops raising rates, that's the pause. When they start cutting rates, that's the pivot. That's the story from here. I thank you so much for watching and for listening to my commentary. If you have any questions about this or anything else financially related, investment related, please ask me in the comments. And even though the show is over, I will see those comments and I will get back to you. And if you don't mind giving me a thumbs up or a heart or an applause, help spread the word about the show to the rest of your connections. We always appreciate that. That would really help the show out. And I'll speak with you tomorrow. Thank you so much.